while some online bullion dealers continue to charge almost $2 over spot for 1 ounce silver rounds, SD Bullion is selling 1 ounce silver rounds at only 49 cents over spot on any quantity. Again, that's $9.99 fine silver for just 49 cents over spot for any quantity. If you haven't joined the over 40,000 precious metals investors by making the switch to SD Bullion, what are you waiting for? You could save hundreds or even thousands of dollars on your next order. SD Bullion, the lowest prices, period.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today is our good friend and fund manager, Dave Kranzler. Dave, it's great to have you back.
It's great to be back. I hope your audience isn't getting tired of me.
Well, I doubt they are, and it's certainly finally been a positive week here for the metals. Recording here late in the access session on Friday. Gold's hanging in above 1250, about 1255 right here. It's traded as high as, in the 1260s this week. Silver traded up almost all the way up to $17. Was smacked down again late Thursday morning, but it's recovered also here on Friday and is recording the afternoon. It's trading about 1685 to 1690 right now. So what's your take here on really the past week's trading here, Dave, and the nice rally we've seen after the 3-week smash that preceded it?
That's a great question, Doc. Certainly gold's had a nice bounce here off of the recent smackdown, but there's also, there's a lot of evidence of visible price capping going on in the New York and to some degree in the London market using the usual paper derivatives that they seem to love to use. So I'm still of the opinion that we started a new bull market in the precious metals in mid-December 2015, and after a big run up through the end of July in 2016, we had in any other era it'd be called a natural price correction. This was kind of a price correction that was aided and abetted by manipulation from the usual suspects. And that kind of went on pretty much through December, where I think we probably hit another bottom again right around the same time that we did in 2015. And it's been choppy trading for sure, and it seems to be kind of dependent on what any given Fed official says on any given day, or what's going on with the Trump administration. And to me, that choppiness doesn't necessarily reflect what's really going on beneath the market at the fundamental level. And what I'm seeing based on all of the research I have access to is that right now the two biggest buyers in the world, China and India, they're the two most visible buyers. There's certainly plenty of other buyers of gold. They're buying gold right now hand over fist. So to the extent that the Western central banks want to keep a lid on the price of gold, they're just making a lot of very happy Indians and Chinese. So, and again, we're kind of, we're at that struggle between the paper market and the physical market. And I think I just happened to pull up a monthly chart of gold that goes back to mid 2007, and if you look at it on this basis, gold's been kind of trending between, call it 1400 and 1100 since the middle of 2013. It's kind of interesting because I hadn't noticed this before, but it's been kind of trending sideways like that. And you can see the uptrend that started in late 2015. So I think at some point the physical market's going to push gold and also silver kind of up above this sideways trend to the next level, which would kind of take us to the 1400 to 1600 range. And again, I don't want to offer timing on when I think that'll happen. I just think that if you've got room to add physical gold and silver or mining shares to your portfolio, you should be doing it now.
We were talking about the show before the show about how it's very likely that a lot of people are going to start to recognize this shift in gold when we see gold get over its overhead resistance for longer term charts, and all of the technical and momentum people look at and go, gee, maybe there is a new bull market. We have higher lows, we have an uptrend, and despite all of the media drumbeat about gold being a lousy asset and all that, I think more people are going to turn toward that. And the U.S. dollar is like a big flashing billboard advertisement for people to consider alternative assets. I mean, we're recording now, about just shy of 3 p.m. Eastern time on Friday, and the dollar is accelerating to the downside. The U.S. dollar index, the DXY, is down 68 cents right now. That's a pretty big move, and it pretty much started only like it looks like early in the morning session, and that's after yesterday's big jump up after the day before decline. We've got a presidential administration that wants a cheaper dollar. We got this global economic downturn and confidence in the U.S. as well, with all of the impeachment talk and the high conflict and partisan politics in the United States being about as aggressive as I've ever seen in my entire lifetime. All of that undermines confidence in the economy, and it looks like people are selling in May and going away when it comes to the standard stock market. So I was wondering what you think about the U.S. dollar, Dave, and how that all fits into this and where we are when it comes to the cycle with precious metals.
What do I think about the U.S. dollar? I think at some point we're going to be using it for toilet paper because we won't be able to get a hold of real toilet paper. That's a good question. And I was actually looking at this last night kind of to prepare for today. And I'm glad you brought up the dollar because I forgot about it. But the dollar right now is back to the level where it was just before the election. And if you recall, just before the election, the stock market started selling off pretty abruptly, and the precious metals started taking off. I mean, I thought we were going to really take off at that point in the precious metals. And then remember the behavior of everything during election night until Trump accepted victory. And then all of a sudden they came in and they annihilated gold and silver with paper. And they propped up the dollar and they propped up the futures. I mean, if you remember, I think the Dow futures were down. Again, I don't remember exactly. I think they were down something like 600 or 700 points, maybe 800 points at one point. Right. And they did a miraculous U-turn. Well, if you look at the chart of the dollar I'm looking at, it went straight up, and it's been selling off really since, well, mid to late December, which is about the time that gold and silver started pushing higher again. And like I said, we're back down to the level where the dollar was right before the election. And Eric, you had mentioned you think the dollar is going into the 80s at some point here, and I don't disagree with you. I think we're going to see that too. I think right now their Maginot line, if that's what you want to call it, is probably right around the 90 level. And if it breaks the 90 level, I think, all hell could break loose in our markets. And I don't know the timing. I don't want to put out timing on this because of all the intervention and obvious intervention that's going on, but it to me, it is an inevitability.
Just as a side note, too, it's kind of interesting to see how over since the 2008 crash, we've seen central banks not uniformly and perfectly, but generally speaking, do rotation when it comes to their big credit impulse. And Fed would be dumping QE from QE2 all the way through, and then Bank of England picked up the slack, and the ECB has been the more aggressive central bank recently. And it looks like we might even see some rotation. If we do see the economy turn down, we have economic indicators that are clearly painting that picture. What's the Fed to do in, say, December of this year? If we have an asset correction that freaks out the policymakers and they're worried about the economy and its impacts from, the stock market rolling over, you got to wonder how that's not going to be good for the dollar if all of a sudden all this talk of interest rate normalization goes out the window after they magically pull off one final interest rate hike, which is what I think they're going to be able to do, and then have things fall apart on them. That will bring in the talk of more credit and a weaker dollar and tailwinds for the precious metal sector. I think that's generally speaking what we're going to see this year unfold. I know you're following the economy pretty closely. Where do you see us now in terms of the day of reckoning when people recognize that the economy is, and I speak more of, the conventional Wall Street world, where would you think that they're far from recognizing that things are not as rosy as CNBC and Bloomberg would like to paint?
Hey, I thought we were at full employment. Isn't everything great? People are buying new cars, buying houses, taking on lots of credit card debt. That's what the TV's telling me anyway.
They're beginning to report, though, that, there's trouble in the auto sector. And so, it's only so long that they can hide the turd under the carpet.
Ooh, that's a rough visual. Well, I've actually been, because of my, publishing the Short Sellers Journal, I spend a lot of time all week long digging for real data, as much as it is possible to source real data. And a lot of what, we've become a headline-oriented society where you see the headline and that's the truth. That's what it is. So, unemployment 4.4%. That's what it is. And we know that's not true. So in terms of auto sales, I think the auto sales are starting to come down very quickly, like much more quickly than is evident in the seasonally adjusted annualized rate reports that come out. I know through the end of March, auto sales were down 10% from the end of December, and I'm positive they're down a lot more since then. And we're also starting to see the delinquency rate for auto loans is pretty much at the same level where it was back in 2008, and most people aren't aware of that.
We like the origination fraud for loans to people trying to buy cars.
It's a huge component in the auto market, and it's also becoming a component in the mortgage market. But when most people think about what happened in 2008, they're thinking, oh, geez, you had this huge default rate in mortgages. Well, the crisis was kicked off when mortgages were defaulting at the 5% level. And I didn't even realize that the default level was that low right before the crisis hit. Until I started researching it. I just assumed it was at a higher level than that. And honestly, that's something I should have known, but now I know it. So, and I think what we're seeing in the auto market is going to start spilling over in the housing market. We're already seeing it in the commercial real estate market and the multifamily housing market. Bloomberg had an article out yesterday about what's going on in New York City commercial real estate, and it sounds like it's starting to snowball into a potential crash. But the demographic statistics can be a powerful tool, and when you start seeing default rates on auto loans creep up, all of a sudden, to me, that's going to spill over into the mortgage market, because we've had such an expansion of mortgage debt and a lowering of credit standards. I mean, we're not seeing the outrageous 125 to value, no interest for a year, and then 2% interest for 3 years, and then it adjusts. We're not seeing debt like that, but you are seeing plenty of debt being issued to people who don't really put down a down payment, and they're basing the amount of mortgage that they're taking out to buy a house based on their monthly cash flows, and people are the average household probably at this point is probably devoting about 60 to 70% of their income to debt service, mortgage, credit card, auto, etc. And that's a precarious position to be in. And I don't think we have a lot longer before that foundation starts to crumble.
That's about how much I devote to food for my 3 boys, Dave. About 60 to 70%.
That's, you know what? That's almost like having debt, except you can't default on that, right?
They don't ever stop eating.
Doc lives at Costco.
That's right. Costco, Kroger, multiple times a day. I need to set up a distribution network and just buy direct. Well, let's talk a little bit about the physical market here. With the sell-off, 3 weeks of consecutive declines in gold and silver, physical demand picked up in a big way. It stabilized a little bit this week, but it certainly remains elevated over the really slow demand we saw in April. The U.S. Mint has sold a little under 1.6 million Silver Eagles month to date, so we're on pace to be just under 3 million. Which isn't a crazy number, but it's much better than 800,000 in April. More interesting or more significant, over the past week, with the increased demand, all of the secondary market, whether that's 100-ounce, 10-ounce, generic round, 100-ounce or 10-ounce bars, generic rounds, backdate coins like backdate Maples, backdate Eagles. There's really been a glut that had built up over the last 3 to 4 months. And that's all been taken off the market and taken down with this latest uptick in demand. So that's an encouraging sign. But as far as fresh, currently minted things, we haven't really seen any problems with shortage or availability. I mean, maybe a couple of things here or there are delayed a week, but nothing really indicating that a shortage has begun. I think we'd really probably need to see, in my estimation, about 4 to 6 weeks of sustained demand, the levels that we're seeing right now, before we start to see real retail shortage product. So again, it remains a good time to buy as far as premiums wise. Products really across the spectrum are available. Outside of a couple of things like the Frederick Douglass ATB, the Mint suddenly sold out without warning last week. So outside of a couple of things like that, but if you're not choosy in your products, there certainly is quite a bit of available inventory right now at just about as low premiums as they get. So still a good time, in my personal opinion, to continue accumulating.
So where do you think we're going as far as the summer, this coming period, Dave? Do you think that the summer doldrums are going to be absent and missing in action? We have this cycle where for the last 20-some-odd years, it was reasonably well established that the trends of buying for Western markets and Western participants in the summer taking off as well too, combined with trends that we'd see in India and so forth, having established what people got used to seeing as a summer doldrums period for the precious metals. But in the last 5-some-odd years or so, certainly in recent years, we have seen summer actually surprise people. We just came out of a pretty big correction. We started sliding down mid-April. I believe that we're not going to see summer doldrums going forward, and that we actually bottomed already. We bottomed, as I was talking about in last week's show, last Wednesday in silver. I think that that's going to hold. Some people will probably be surprised to see missing in action summer doldrums, and I know that you're of the view that summer doldrums are not going to be something we're facing in the months ahead, and that'll be a productive thing for us to talk about a bit, and I'd love your thoughts on it.
Sure, that's a great topic, Eric, and you're right. For quite some time, there was a little bit of a seasonal pattern that was tradable. I mean, it wasn't 100%, but it was definitely tradable. Where it was essentially sell in May and go away, and then part of I'm not, and like you said, I'm not sure that seasonality, I think it's kind of washed out of the markets at this point. Part of it is because the hedge funds started seeing it and they started anticipating it. And, all of a sudden, a late August sell-off turned into an early August sell-off and then a rally into Labor Day weekend. So that's kind of part of it, is I think the hedge fund black box computers have somewhat adjusted to it. But also, and again, I can't really necessarily pinpoint it, but somewhere in sort of the 2008 to 2010 area, China became a much more visible participant in the physical gold market. And there's really, might be a little bit of seasonality in their buying patterns, but it tends to be short, like when they shut down for their New Year's celebration for a week. They're buying hand over fist year round. So I think that's somewhat smoothed out the seasonality that we used to see prior to 2008, 2009. And also, I think this overt intervention in the Indian gold market to try and get their population from buying so much physical gold, I think that kind of throws the seasonality a little bit out of whack. Because I know, historically, the seasonality you were talking about, by the time we're in mid-May, India is starting to wind down a little bit. And right now, based on the data that I have access to, primarily John Brimlow's Gold Jottings report, which is a daily thing. He reports on India a couple times a day. They're buying a lot of gold right now, and I think a lot of it is just sort of a snapback effect to the intervention that occurred with their currency right before the end of 2016. So I tend to agree with you, because I think you got a whole confluence between physical demand and rising geopolitical risk and rising economic uncertainty globally, not just in the United States. I think we're probably not going to see the seasonality that people assume is usually there in the summertime. So I guess the bottom line there is, if you're expecting to get bargains in the middle of July, I wouldn't necessarily expect it. I mean, you're not going to be able to buy silver and gold as cheap as it is now a year from now, in my opinion.
And it also gets back to what we were talking about in the front of the show, about how all of a sudden people are going to be looking around 2 weeks from now and seeing gold actually giving a signal of a new bull market underway.
All right, well, before we wrap up the show, guys, anything else we want to discuss today?
I guess we're good.
Along with this idea that I think we'll be higher now going into the fall in gold and silver than I think we'll be higher then than we are now. I think it's also a good opportunity to add to your mining stock holdings if you dabble in the mining stocks. I mean, the Huey's below 200 again, and it's up about 1% today. But relative to the price level of gold and silver, the mining stocks are still historically cheap, and the juniors had a huge rally last year up through August, and then for a lot of them, most of those price gains got taken away, and yet nothing necessarily changed fundamentally with their business models. In fact, I know from talking, for putting together my mining stock journal and talking to a lot of junior mining stock executives, right now they said essentially the way they stated it is smart money is throwing cash at us. And so, it may not quite be a ground floor entry spot in these stocks like it was in late 2015, but, now's a good time to be adding to some of the names that have been eaten up over the last few months. You don't want to run scared from these stocks at a time like this. This is when you want to be buying them, because this is where the really big money can be made.
Yeah, certainly sentiment across the whole sector is, I've never seen it this bad, and that's saying something.
Sentiment's usually a pretty good contrarian indicator.
Yeah.
So for our listeners and readers, Dave publishes a mining stock journal, and that can be accessed at investmentresearchdynamics.com. And it's a great newsletter. He covers a lot of macroeconomic dynamics and how that plugs into stock picking in the mining sector. It's a tough sector to follow, too. The individual investors don't always have a lot of time to dig into what's going on with the company and keep up to date with them. So, newsletters like Dave's are really helpful, and I love his work.
I appreciate that, Eric.
You also do the Short Sellers Journal, keeping abreast of macroeconomic trends in the United States, global macro too, and how that relates to where our stock market is. And you're running that as $20 per month, correct?
Each individually is $20 a month, and then if you subscribe to both, it's a total of $30 per month. So you get 50% off the other one.
I highly recommend them, and they're great letters, and our listeners and readers should check them out.
Appreciate that.
All right, Dave, it's great to have you back on the show with us. Thanks for joining us.
Hey, it's always great to be here. Love the discussion, and I especially love hearing about what's going on in the physical side in the coin market and bar market.
Yeah, it's definitely an interesting time in the markets, and while we all know that there'll be better days ahead for gold and silver, hang in there, guys. I think it's coming, and it could be sooner than any of us might believe here. So we'll see. I remain optimistic here. It's been a long 5 or 6 years, but I don't know. I'm optimistic here late spring as we head towards summer 2017. So.
Well, Eric can testify. Usually a big move in the metals is on top of you before you even realize it's happening. And then all of a sudden you look up and it's like, oh, I should have bought a couple weeks ago.
Yep, it's very true. So hopefully we'll have another one of those big moves on top of us very soon, even in 2017. So that sure would be nice. It's been a while. All right, so for the doc, Eric Dubin, and our good friend Dave Kranzler, thanks for tuning into this week's SD Weekly Metals and Markets.